In the shadows of traditional Wall Street, something remarkable is happening that most investors do not fully comprehend. Artificial intelligence powered robo-advisors are fundamentally transforming how trillions of dollars flow through global financial markets, making sophisticated investment management available to ordinary people at a fraction of the cost of traditional advisors. This transformation is not coming in the distant future. It is accelerating right now in 2025, reshaping the competitive landscape of global wealth management in ways that traditional institutions are struggling to adapt to. The numbers tell an extraordinary story of disruption. The global robo-advisory market was valued at $10.09 billion in 2025 and is projected to expand to $133.94 billion by 2035 at a compound annual growth rate of 29.51%. Assets under management through robo-advisory platforms have surged to remarkable levels. Robo-advisors managed over $1 trillion in assets globally by 2025, with the United States alone representing vast majority of this total. By 2027, these platforms are expected to manage $2 trillion in assets, a figure that would have seemed impossible just 5 years ago. The speed of this transformation has caught traditional wealth managers off guard, forcing established institutions to adapt or risk irrelevance. Approximately 62% of investors now prefer automation, and 55% want personalized insights, while 48% of institutions offer hybrid robo-services. This represents a fundamental shift in investor preferences that goes far beyond novelty. Younger generations, in particular, are embracing this technology at extraordinary rates. Over 40% of millennials and approximately 40% of Generation Z prefer robo-advisor investing strategy. These percentages represent the future composition of the investing public, suggesting that robo-advisory adoption will only accelerate as generational wealth transfer occurs. The performance revolution, the fundamental question every skeptical investor asks, is simple: do robo-advisors actually perform as well as traditional advisors? The evidence is overwhelming that they frequently outperform. Charles Schwab's expansion of intelligent portfolios in 2024 led to a 28% rise in client engagement, with approximately 40% of hybrid robo-advisory clients reporting improved satisfaction with new personalized planning features. These satisfaction improvements directly correlate with performance improvements because robo-advisors eliminate behavioral mistakes that plague human decision-making. Betterment reports that nearly 70% of customers using tax loss harvesting covered their taxable advisory fees through estimated tax savings alone. This transforms the entire economic equation. Investors are not paying for advice; the tax efficiency of the algorithm pays for itself. Meanwhile, Wealthfront's data showed their daily tax loss harvesting produced an average of $7,700 in harvestable losses for $1 million portfolios during 2024's volatility. When multiplied across thousands of clients, these optimization gains add up to extraordinary wealth creation. The behavioral advantage of robo-advisors extends beyond tax optimization into risk management and emotional discipline. During market corrections, human advisors often feel pressure from panicked clients to sell at the worst possible time. Robo-advisors execute their strategies mechanistically regardless of market conditions. When panic selling occurred in mid-2024, robo-advisors identified these periods as statistical opportunities and systematically purchased undervalued assets, while human traders often froze or capitulated to fear. Over multi-year periods, this emotional discipline translates to performance differences that dwarf the fee savings. The democratization phenomenon, perhaps the most significant impact of robo-advisors, is democratization of wealth management. Traditional financial advisors primarily serve wealthy clients because the economics work only at significant asset levels. Robo-advisors reverse this equation completely. Betterment accepts accounts with no minimum. Wealthfront requires only $500. Charles Schwab's Intelligent Portfolios requires $5,000. Vanguard's digital advisor has a $100 minimum. These are price points that enable ordinary people to access institutional-grade investment management. Approximately 64% of Generation Z favor digital tools, and 45% of platforms now offer ESG portfolios, while 38% include cryptocurrency investments. This expansion of available options reflects how robo-advisors are evolving to meet diverse investor preferences that traditional advisors struggle to accommodate cost effectively. A traditional advisor serving a client who wants to allocate a portion of their portfolio to sustainable companies or cryptocurrency would require extensive research. Robo advisors can offer these options as standardized modules, dramatically reducing implementation costs. In 2024, Vanguard introduced an ESG-focused robo advisory solution designed to appeal to socially conscious investors, with nearly 36% of new users in 2024 opting into the ESG model. This demonstrates that even established institutions with deep roots in traditional investing are being forced to innovate rapidly to serve evolving investor values. Younger investors care about impact alongside returns, and robo-advisors are making it economically viable to serve this preference at scale. The geographic expansion of robo-advisory services is equally remarkable. North America emerged as the largest region in the market, representing 47.37% of global revenue in 2024, followed by Asia Pacific and Western Europe, with the fastest growth rates expected in Asia Pacific and Eastern Europe. In Asia Pacific specifically, where traditional advisory infrastructure is less developed, robo-advisors are leapfrogging traditional models entirely. Platforms like WealthNavi in Japan and Uprise in Thailand are serving millions of investors who would never have had access to professional investment advice. The integration into traditional finance, large financial institutions cannot ignore this trend and are integrating robo-advisory capabilities into their existing infrastructure. JP Morgan's artificial intelligence-based cash management tool dramatically improved efficiency for institutional clients, with the system cutting manual processing by 90% for 2,500 clients. Siemens Treasury's digital migration demonstrated tangible cost savings, shaving $20 million in yearly costs by implementing programmable payments and blockchain rails that support real-time rebalancing. The insurance and banking sector integration is particularly significant. Robo-advisors are increasingly embedded into employer 401 plans, insurance products, and banking relationships. When an insurance company can offer robo-advisory services as an optional feature of a policy, or when a bank can offer robo-portfolio management alongside deposit accounts, the reach and impact multiply exponentially. The healthcare sector was the largest and held 33.2% of the robo-advisory market share in 2024, with hospitals and healthcare systems increasingly partnering with robo-advisory firms to offer financial wellness programs as part of employee benefits. The Mayo Clinic's robo-advisory pilot in 2023 resulted in a 41% increase in 43 plan participation among staff. This demonstrates that even institutions serving highly educated, high-income professionals see value in making automated investment management available. When stress-burdened healthcare workers can automate their investment decisions rather than struggling to manage investments themselves, they make better financial progress toward retirement. The regulatory landscape and compliance. The regulatory environment is evolving to support robo-advisory growth while maintaining consumer protections. Europe's ESMA has issued artificial intelligence guidance that clarifies compliance guardrails, fostering institutional uptake. North America's regulatory clarity, including the Department of Labor's fiduciary rule, has encouraged adoption of transparent, algorithm-driven advice while ensuring baseline accountability. This regulatory clarity removes uncertainty and allows platforms to scale with confidence. However, regulatory complexity remains a barrier to entry for some providers. The Securities and Exchange Commission's 2025 Internet Advisor Rule restricts exemptions to firms serving clients exclusively via interactive websites, raising compliance budgets for some platforms. Europe's artificial intelligence guidelines under MiFID require bias testing and explainability, complicating cross-border scaling. Despite these challenges, the trend is clearly toward regulatory frameworks that enable rather than obstruct robo-advisory expansion. Looking forward into an automated wealth future, the trajectory of robo-advisory growth shows no signs of slowing. As technology improves, costs decline, and younger investors become larger wealth holders, robo-advisors will capture an increasing percentage of total assets under management. The future will likely belong to platforms that successfully blend algorithmic optimization with human touch when needed, that offer diversified investment options matching evolving values, and that integrate seamlessly into broader financial lives rather than existing in isolation. Traditional financial advisors will not disappear, but their role will transform. The advisors thriving in coming decades will be those who embrace technology, use robo-advisory capabilities to eliminate administrative burden, and redirect their limited human attention toward client relationships and complex planning. The pure Robo advisor platforms will continue capturing assets from price-sensitive, tech-comfortable investors. The true winners will be those offering effective hybrid models that deliver both computational precision and human wisdom when it matters most.